Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 16th, 2022. It is 9:56 a.m. Eastern Time. I'm starting the video, so we're about a half hour into the trading day, and I wanted to do an update, a brief update on the equity markets, as well as some of the other things that I've highlighted recently. We'll look at cotton. I mentioned that as a short trade a couple weeks back. Natural gas, I mentioned that most recently as a long. I'm often giving long and short trade setups on nat gas. And I'll do a brief update on gold. If there's anything else I can think of during the video, that's it. But those are the ones I just wanted to get out to you. So let's start out here with the equity markets. And we're looking at the weekly chart. So this is the bigger picture. I want to speak to that first, then I'll jump down to the shorter term time frame. So, I'm still keeping my eye on the prize, and that is, referring to trend trading. I do believe, and again, if I'm proven wrong, charts start to prove me wrong, I'll let you know. But as of now, I'm still maintaining that I think we're in the beginning of a early stage bear market action, or at least a much deeper correction. And this is a weekly chart, so the most important thing to look at now. I'm not going to recap what's happened. We all know that. If you're new to the site, catch up on some of the previous videos. But basically, we had that trading range there and multiple shorting ops at the top, especially with entries honed down in on the 60-minute time frame. But since then, we broke that range and we've set up. I'm going to zoom in nice and tight here. We had an impulsive leg down off the top and set up into what appeared to be bear flagging action right there. And we broke down last week. We had an impulsive red candle, big breakthrough there. Again, bear flag would look like that. Flagpole followed by an area of a little snapback rally, and then an impulsive breakdown. So this will be important this week. We've got a couple trading days left. Remember, we're not even halfway through the week. Midday today, we will be. So what ideally, and again, you don't always get what you want. You don't always get ideal breakouts and patterns, but ideally for the bearish scenario, we'll want to see additional follow through on this candle. Right now, remember, we're looking at a weekly chart, and as I just said, the week isn't even halfway over yet. So we need to see how this candle finalizes. We had the big red candle coming out of the flag last week, and so ideally we'll see, you want to see this candle red. And as I like to say, the redder the better. And I say that because especially with a bear flag pattern, that's the nature of it. The move out of the pattern should be equally as impulsive, roughly. It doesn't have to be exactly, but roughly as impulsive as the flagpole, the move leading down to it. So that's what you want to see here. You don't want to see this. If you get that, it doesn't eliminate the bearish case at all, but it just keeps things into question. It keeps the possibility of a move to new highs, a possibility that the correction was over when my first target there was hit. A lot of possibilities. But as of now, we're below the 200-day moving averages. I've talked about that extensively, and I've gone over and compared previous corrections of this magnitude, and where this was the first leg down, or that was. And when you take out the 200s, you usually almost always kick back if you shoot right through them, back test them, and that's what happens. So, and I keep warning of the potential of a very swift drop. And again, yeah, it doesn't. Anything can happen. We can consolidate for a while, still get to T2. We can go up here, get to T2. There's a myriad of possibilities. I'm not here to tell you that anything can happen because that's a given. But what I'm talking about is probabilities and things that if you see those developments, the takeaway is maybe you want to jump in on it or add to shorts, get aggressively short. Because if we break down in this week, heading into Friday's close, if you see that this candle is poised to, print a solid red close right here, a red candlestick this week, and it's down there at or near those previous lows, lower the better. Again, because if we took them out, that'd be all the better. Then that's what you want to see, and you might then make a decision to go home, add on shorts before the weekend, or initiate a short position. It's all up to you. So from where we're at now, just to kind of recap, if T2 is hit, my second target, that'll be a 15% drop from where we're at. And roughly, I measured this before we even peaked. I gave you my targets here right around when we were peaking. So I said that would be roughly 16%. We overshot T1 intra-week and then parked right above it. So it turned out to be closer to 18% drop overall. But again, 16 is where That's what I was calling for before, and that's so far that's where we ended the week. So if you were, holding on to a short, wrote out the counter trend bounce, that's where we're at. So that's bigger picture. Again, takeaway on the long-term chart, bear flag, broken down, but ideally to really say with a higher degree of confidence that was a bear flag, you'll need to see some follow through this week. Want to see a red close in the indexes. S&P 500, same story. Primary trend line break there, divergent high on the weekly, impulsive leg down, i.e. a flagpole, followed by a bear flag action, followed by a red candlestick last week. Let me turn off all the lines there so you can see it. Once again, flagpole, bear flag, breakdown candle, flirting with the 200s right now. Remember, the Qs are below the 200 days. They've already failed several back tests of the 200 days, whereas the S&P 500 has failed. It tried to recover on a weekly basis, kept failing. This week it ran up that blue line there. It's a 40-week exponential or simple moving average on the weekly chart, 40-week, but that's the same as the 200-day moving average on the daily chart, which is a big level. So far we're under that as well, and that's the one that's in recent rallies has capped the advance. So again, I just want to say this is the strongest evidence we've had so far of a much more powerful sell signal, and time will prove me right and everyone else right. Bulls, those bullish. That's still the majority. I imagine pundits on Wall Street believe that this is a correction and a buying up. And although growth may slow with the Fed raising rates, they think it's still a high growth environment, and they think that's what it is. So we'll see who's right, who's wrong. And again, if I'm wrong, I'm not going to sit there and stay short to new highs and beyond. But I think again, I keep saying the risk reward is skewed, in my opinion, to the downside. And if we're at where I think we're at, again, I think the odds are pretty good for a pretty impulsive leg down, and that would be commensurate with how a bear flag plays out. So let's see what happens this week. If we don't get it, and then we flounder around, then I'm just going to say, look, well, the 200s are still the 200s. Resistance, which is the top of that trading range, and those new highs is still resistance. So we may consolidate for a while. Anything can happen, but I'm just laying out the possibility that these bear flags could play out, and if so, you need to act quick, because if you wait till we're halfway down, that's just could be a matter of a couple days. And then you really don't have a very objective shorting op at that point if we're shot down, drop 10% in a matter of a few days. Okay, and then last but not least, I'd like to cover the small caps as well. Let me extend that. That was that beautiful year-long trading range right there. Talked about it quite a bit. A little false breakout there. Our major sell signal when we took out the bottom of that year-long trading range. With same thing on the large caps. You have the impulsive leg down, i.e. flagpole, and a bear flag, which is yet to break on IWM. So that's something to look for there as well. Look for an impulsive move out. It's about where it should break if it's going to break. And again, I pointed out recently you had one of the best shorting ops in a while right here on this kickback to that well-defined resistance level, about 209 on IWM. So that's what we need. And, if we don't get that, then let's see what we get. You know me, I'll continue to update the equity markets no matter what happens. But there it is. And my measured target on the flag comes perfectly to the 171 target I laid out well before we even broke down out of the trading range there. That was my was and still is my primary swing target at this point in time, where I plan to cover shorts and reverse to a long position, most likely, if and when we get. And the short-term charts, I'll skip the dailies, just jump down to the 60-minute charts. I gave you the charts of the futures this morning, so there's not much more to add to that. These were, we had multiple shorting ops from this breakdown here, or was it this one here? We had quite a few recently in recent weeks, and every push back to this level. Again, I had a different chart with different levels, but about 405 there, and that's where I highlighted multiple shorting ops. So that's really where the trend position short began and still is in play, and then is an active trader, and I tend to wear that hat, especially my active trading account. Then I'll game, covered, like I mentioned, you could cover there when T1 was hit, game the bounce, and most recent short entry was back here at the 370 price resistance plus 50% fib, and that lined up exactly with the 61.8% fib on the S&P 500, and so far so good. And the takeaway, like I showed you in the chart I put out this morning, is if you look at it very simple. The case was made then that this was a counter trend rally, one that you could trade long and or position short on when it ran its course. And so far, we have the makings of a near-term downtrend. Downtrend's defined as a security making lower highs, which we have there, and lower lows. So now what do we need? Well, we need to take out that low, and that would keep that downtrend going. Bulls want to see each of these highs, particularly that key rejection there, because remember, it wasn't just the 61.8. That's why I cover or 50% on QQQ, Fibonacci retracement. That's why I cover multiple time frames. It was also rejection off the 200-day moving average and price resistance, a lot of other things there. So anyways, until then, kind of the takeaway is that's why I started out with the longer term charts and said, I'm keeping my eye on the prize. Big picture stuff. If you are frustrated and let's say you're short and every time we rally up 3%, you second guess that, you stop out, then this isn't for you. You're probably not cut out for especially down trading a correction, because volatility, the one guarantee you're going to have in a bear market or a significant correction is a lot of volatility. And volatility doesn't mean straight down. Yes, the VIX tends to go up when the stock market drops, but once that volatility spikes, the counter trend rallies are just as powerful. And if you're not, a very active and nimble trader where you can game those counter trend bounces, then you either need to stay in your positions with the appropriate stops in place. And again, that is whatever those stops are depends on your both your price target or targets if you plan to scale out and your entry prices. If you shorted all these opportunities here and you're going down for T2, T3, or T4 on my weekly charts, then at the very least you can have a stop at take your average cost and have a stop at your break-even price, so you lose absolutely nothing. If worst case scenario, this was just a correction, it's over, and we're going to blast off the new highs, then that would be it. Otherwise, you can trail your stop down, periodically lower stops as the market drops, and then you'll guarantee a profit even if you get turned around, the market turns around, stops you out. And of course, with any trade, the wider the stop, the less chance you're going to have of being stopped out. If you think security is going from here, point A, down all the way here to point B, it's not going to go straight there. It's going to have these counter trend rallies. And, it's a double-edged sword of pros and cons. The wider the stop, the more profits you get back if you are stopped out. But the tighter the stop, the more likely you are to be stopped out in a little kickback rally on the way down to your target. So I'll let you decide where that is. At the end of the day, ultimately my stops are largely based on the risk-reward ratio. I'll risk 1 unit of loss for 3 or more units of profit, ideally. And I also then will take those, I'll take the resistance levels nearby. Let's say in this case that I'm short, my stop will be placed a little bit above a resistance level. And again, depending on the time frame I'm trading, maybe on a daily close, maybe on a 60-minute close, sometimes even on a weekly close. All right, that's it. We'll move on since I already gave you these charts this morning. There's again that 50% fib, which so far has proved to be a very nice shorting op, along with the 61.8 fib on the S&P 500, both ES and SPY. And as I mentioned this morning, that's that area I circled. We're stair-stepping lower, and so we want to see that low. And I think when this low is taken out, you'll start to see stops hit. Any longs that bought in here, remember that was a consolidation for a few days and we broke out. So the top of that's support right here. We've briefly dipped below it, but now we need to take out that low. And if we do, let me show you one more thing. Let me add something on here. We've got a potential uptrend line there off the lows that I should have marked. So this should be it right here, guys, and I didn't have that on the chart this morning. Okay, so that's it. Maybe add that line to your NQ chart, and if we can take that out, that should get us going down to the downside. And of course, we take out those recent lows and all the indexes, barring any brief whipsaw with the divergent low or anything like that. That should do the trick. But I'll update you if that happens. We get near those lows, I'll certainly give you my thoughts at the time. And then just real quick to loop to that S&P 500 chart I gave you this morning, or ES stock futures. You had a downtrend line here, and in that chart I showed you this morning, you had resistance right here. It was really the top of this trading range, and we broke above it. We back tested twice after getting rejected off that 61.8% Fibonacci plus price resistance there. So that is the big resistance level up here. Should SPY pop up, or ES, the S&P 500 futures. But right now, the closest resistance level is this one here. So you can take a short right there, right where we are, or right where I give you this morning. And I would have a stop somewhat above that downtrend line right there. I'd probably move that downtrend line up just a hair to cover that recent reaction high. I'm trying to do it here. There we go. Do that, and then pull it down here. And so that's roughly it. So that's it. So you can short that resistance level right there, and or up to there with a stop somewhat above, or big level right there. Really at this point, now that we've had two reactions, don't want to see them pop that level there, which is about 45. We'll call it 4,600 to be safe on ES. That ideally should contain any snapback rallies now. It's pretty big resistance. Okay, next up, cotton. I laid out cotton as a long-term swing trade. I've been all out bullish on commodities for the last couple of years, and a lot of them have had great runs, cotton included. But this one, I have two longer-term trend lines. This is a daily chart. We're starting out on 2 years price history. You can see up top. Daily candlesticks, and so what I had highlighted a couple weeks back is we had negative divergence on that daily time frame, pretty big divergence, and again, it's been a hell of a run. I don't think the bull market is over in cotton or any commodities. I think we're in the early stage of inflation that the Fed is still, in my opinion, they talk about Powell pivoting and a hawkish Powell. In my opinion, and that of some others, he's still way too dovish at this point in time. Cat's out of the bag, and all he's doing right now, he hasn't done a thing. Well, he's tapering the bond program, but all he's done is tried to jawbone the market down. Talked about raising rates. We haven't seen a rate cut yet, and he should have long ago started pulling us off the floor, off that zero interest rate policy. The economy could have certainly tolerated it then, and so now he's in a position where the further you get behind on this, the harder it's going to be to control. But either way, I do think based on the technicals here, you have a breakdown in cotton. I gave you the long-term targets on this daily chart. I have a 116.44 there, 1.1013, and this is where I think ultimately cotton's going to come back to and then resume its bull market. And this is a sorry guys, that just vanished. I hit a escape key right here. So you had the primary uptrend line, and then right at $1, 1.0051 right there. This is where I think cotton's coming down to, and to try to measure it for you, that would be a drop of about 17% right now, roughly. All right, so let's zoom down, step it down to let's go down to let me see what I have on the 2-hour chart for you. Okay, so 2-hour candles or 60-minute, you can go to, these are 120-minute candles. See this? This was a divergent high right here. See your negative divergence, boom, boom. And you had a nice clean trend line break there. Went sideways, then it broke horizontal support, and then boom, nice correction, right? That's what you want to trade. That right here, same thing. You have a nice clean uptrend line, which was just broken. You had divergent, this was a divergent high right here, and that high. Negative divergence right there, almost divergence on that indicator. Then you had price support, which I believe I mentioned in the last update at 1.2231, and that broke. There's your next sell signal. So the trend line break in itself was 1. Then you have a nice little flag here. In fact, let me step it down to a 30-minute chart, and you could probably see that flag a little bit better. Okay, this would be it. Yeah, you can see it right there. Little bear flagging type action. Little move down, break down. We're back testing the flag right now. So longer term, let me go to one other chart here for you. This is my daily chart. Nope, weekly. I'm sorry, weekly chart of cotton futures, and this is on stockcharts.com. You can see it's a weekly chart, and you look for these divergent highs on the weekly. That's negative divergence, big correction. Then divergent lows, I like to go long. Divergent highs, I like to go short. And of course, trend line breaks, you need a trend line break. So it's in this case, you had an uptrend line right there. There was your divergence line, there was your breakdown, and that started this downtrend. Big divergent low at the recent lows and when COVID hit back in early 2020, and it's been nothing but a bull run since. We had a nice clean up trend line here. You had a correction along the way. But this now, so here's where we're at today. We have divergence building, as I showed you on that other chart on the daily. This is a weekly chart, also confirming we have some pretty big divergences building. And then, I know you probably can't see it in the video, that's why I'm going to show you the zoom in here. We have a close-up. This is the trend line I was showing you a minute ago on the daily chart, and you have a smaller trend line right here, and that one I might have showed on the daily as well. And this is right here. This is a thumbnail zoom. You can do on stock charts, and this is that shorter term trend line that was just broken. If you can see right here, that red candle. So that breakdown there, I believe, will bring us back to this trend line, and then we'll have a bounce. And that was the target I just showed you on the daily chart. So there's cotton for you. One trade idea that's was thrown out a few weeks ago. I just want to give you this update. And one of my favorites, I update, highlight trade ideas on nat gas all the time. Fewer things out there put so much money in my pocket, or can put so much money in your pocket in short order. Can take it away quick as well, so don't stay too long on the wrong side of the trade. Use your stops. But we had a nice big divergent high up here, the trend line break there. A little big resistance level there at about $5, a little kickback to that level. But then just the other day I mentioned to you, I showed you this right here, this bullish falling wedge pattern. We're on an hourly chart. I said we had a nice clean downtrend line, positive divergence, everything that I like to see, plus pull back to support. I highlighted this yellow level at 3,928 because we use that back here as a breakout for a long trade right there. And so that's it. So we hit that support level, and we've run up, gosh, it's been about 20%, I believe, so far since, yep, about right close to 20%. And where we're at now, I'm going to add a level because that could be it. If you got any or all of that 20%, I would say right now take the money and run. Why? Here's why. There's resistance. I didn't have it on the chart before when I covered it last week, but it is resistance 4.644. It's this reaction low right here. There were some reactions in there, a couple over there, and then more importantly right here, see this? Got a little bit of negative divergence, and it doesn't take much there. So either tighten up stops or let it go. That's natural gas and that's swing trading. So I think it's a good time to either book profits, like I said, or tighten up stops. If that trend line breaks, then it'll probably take us back. Hard to say. There's some support around there as well. I'm more keen to just get out of the long than to short it at this point in time. And then gold, looking good. We've got, remember, we're only halfway through the week, but I have been highlighting for quite a while this symmetrical triangle on the weekly time frame. Those things, are like a coiled spring, building energy. So far, an upside breakout. Not by a wide margin yet, relatively speaking, of course, relative to the time frame here. Let me tighten that trend line down a little bit. It should be right there. So it excludes that little blow off top right there, and then comes in, captures a couple candles there, there, most recently, and then your breakout candle. But as I mentioned, you have resistance just above about 174 right there. And so once that's clearly taken out, I believe that should do the trick. Now you can always back test, but you never know. So it's an objective long entry. Again, I think the longer term outlook is pretty good for gold. And this will be, if we break above the triangle, most likely it means the bull market consolidation, the high level consolidation or correction phase is over, and we'll probably go on to new highs. Would be my guess. But so far so good. And again, it's a weekly chart, so let's see how we finish the week. Can't get too excited yet. Daily chart. 1 second. Here it is. Here's my daily chart. Same trend line there. I have it in yellow here. You can see right there. I need to drag this back up. Fix that. There you go. There's your downtrend line. There's your breakout intra-week so far, but also if you want to, if you're trading off the daily, there's your breakout back test already, and really need to clear that previous reaction high. And then, of course, you want to see that one cleared, and then that one, and it just each one is a check mark that gold has embarked on the next leg up in a bull market. And silver, gold breakout. If the breakout in gold sticks, so we get some confirmation, then you'll probably see silver not far behind. You have really, actually, I'll show you this. I have a trend line there, but the divergence line is right there. There's your downtrend line. There's your positive, aka bullish divergence on the weekly. So we're testing. We're at trend line resistance now. So if silver can pop it, should be a quick run up to about 23.83. That's pretty good resistance. Probably get a pullback there and then run at those old highs, the previous all-time highs, about 26.80 give or take. Maybe a little bit above that. We'll call it $27. And then boom, a breakout above that would be quite bullish. And before we wrap up here, let me show you a couple individual trade ideas. If you want to hedge your bets, Facebook, I mentioned the other day, Facebook got the snot knocked out of it after earnings. This is my weekly chart. So just summarize. One of the better looking ones in the at top of the NASDAQ 100, the big market leading what I call FANG stocks. There was our primary uptrend line. We had a brief violation when COVID hit. It was a momentum fueled overshoot, but enough reactions to say it's still a valid trend line. It was taken out, and that's longer term bearish. No two ways about it. As I've been saying for over a year now, the market will not break till the market leaders break. Where you can then call a major top, and that's what's happened. The market leaders, one by one, are breaking. Not all of them. Apple's got work to do, and some others, so you can't write off the entire market yet, but you can see Facebook, Netflix, a former market leader, and I'm going to make a comparison. So right here, I want to compare it to Netflix. See this level? We had a major reaction high back here in 2018, right? Big high. Why is that a major reaction high? Well, you can see we had a huge red candle coming off it and a 44% drop, right? And then we came back here, tested it again, got smacked down well into the double-digit drop, and then finally broke out right here. I'm going to zoom in so you can see in the video. Okay, so that was that high. Came in there, got smacked down again, and then boom, big green breakout candle, right? And then a back test, successful back test, and then off to the races to new highs. We're back at that level. On a scale 1 to 10, that's close to a 10, call it an 8, whatever, up there. So what I'm throwing out here is if you are, especially if you're a long-term bull, this is one of the best buying opportunities you've probably had in a long time. Now, I know the stock looks like death right now. Take it, don't take it, that's up to you, but it is at major support. And where would I target it to? I only think it's going to bounce back to about 249. However, if the market breaks down, everything I talked about in the beginning of the video, it's going to be hard to see Facebook mount a bounce of about, from where we're at right now, rally of about 16% if the bottom falls out of the stock market. Longer term, I think Facebook, I don't know if this will be the next target. I'd have to, sharpen my pencil on here. Certainly some stops along the way, probably there at about 193, let's just say an intermediate target. So I do think Facebook heads lower in the long term. This is early stage bear market action. This isn't a bull market correction. The stock is down now about 44%, almost chopped in half. Major trend lines broken. 40-week moving averages way up here. The 40-week, same as the 200 days. But I'm showing you this, that it's extremely overbought. This is the most overbought the stock has been. Really, you can't really count the IPO. The RSI just started there. So the most overbought it's ever. Oh gosh, sorry guys, oversold based on the RSI. And then you look at the daily chart, and you can see it's also very oversold there. Okay, where am I going with it? Okay, so support. Basically, you're just, if you want it, and again, you know my views on the market, but you can take a shot at support. I gave you my bounce target. If you're more bullish than I am longer term, then you can just, if you buy it and it works out and we get to my bounce target, just raise your stop and let it run. Who knows? Maybe we'll go and back test that level. Big level there at 304. But what I wanted to show you is Netflix on the site, posted on the front page with the chart the other day, a couple weeks ago. Netflix. This almost looks like an identical chart to me. You have a primary bull market uptrend line, which was broken right there, right? Then a secondary trend line that was broken. Divergent high. Netflix fell and got smacked down after earnings, just like Facebook. And just like Facebook, it dropped. The drop has been about 40, almost 50%, 40-something odd percent. And just like Facebook, it fell back to, you got it, there it is. See that 2018 major high? We spiked above it there, then had, this was what I call the golden shorting zone, because we first shorted Netflix here. We covered there. When it hit here, we shorted it again. I know there were some long trades in there that we reversed. You can go back on the site. Everything's archived, all the posts. And I pointed out each and every time. So I called that the golden shorting line because it was such good resistance. Ultimately, that resistance level was taken out, and it was on a big green candle and then back tested. So on a scale 1 to 10, that's right up there to a 10. And so a few weeks ago, I threw it out as a bounce trade opportunity with a bounce back up here. I said you wouldn't want to go all the way up there, but close to it. And we actually did hit that in pre-market. That's about 475 right there. And it was good for a 20-something% quick bounce, 22%. And again, I'm going off where I said to buy it on that 387-ish level. I also gave you the daily chart. And again, we had a little momentum overshoot. It stayed within my stop parameters of a stop up to 10%. Never violated that. And then you got a quick 20-something odd percent. And I did an update and said, get out. That's where I would take profits. You get a quick 20-something percent. And look at that. Right back down. So look, it doesn't mean these are two different companies with two different business models. Doesn't mean it'll play out. I'm just throwing out a trade idea to you that saying this to me is nearly identical technical setup, deeply oversold, weekly time frame, but Facebook's still here because Netflix did all this first and Facebook followed. So again, take it, don't take it. Or you consider it a hedge. Let's say you're heavily short the Qs. Of all the components of the top components of what I call the FANG stocks, Facebook, Amazon, Microsoft, Alphabet, if you put a gun to my head, the only one that I would buy and hold right now would be Facebook for that. And again, I'd just be looking for a short-term bounce. So that's that. And as I said, there is that target right there hit. And again, in the pre-market Netflix, that's where I had it on the weekly, came up and made a full punch of that that big topping pattern right there. And this also, when I'm talking about analogies, I could sit here and talk on the markets all day long. I love this stuff. See that? And I always talk about energy like a coiled spring, these tight trading ranges. And then I talk about how vicious I say the most bearish things in investing and trading that I've experienced are false breakouts, bull traps. And that's what happened. Netflix broke above there, looked like it was off to new highs and beyond. Boom, the breakout failed, and when it failed, it didn't just fail, it got clobbered. And so that reminds me of our old friend IWM, the small caps, same thing. Similar trading range, very well defined, similar breakout. And just like Netflix proved to be a false breakout or breakout that failed, it also, like Netflix, had negative divergence. So that's why it's a breakout that I would either short it or not stay long on because of that. Breakouts that occur with negative divergence and overbought conditions usually fail. And when they fail, it ain't pretty. pretty. It's pretty if you're short, but it's not pretty if you're long. And so that's why I think IWM will have the same fate ultimately that Netflix had. All right, let's wrap it up there. That's enough comparisons for today. This has been Randy Finney with Right Side of the Chart. Have a good day.